Everyone.
Good morning.
How's everyone doing?
Great.
So my name is Sam Yu. As Giuseppe just said, I'm been with Primerica for over 9 years. Just a little bit of background about my company. We've been around since 1977. We are a publicly traded company on the New York Stock Exchange under the ticker symbol PRI, and we are currently the largest independent financial service marketing organization in North America right now. So I'm just here today to just teach you guys how to be financially successful. I know you all is everybody here a realtor, or just most of you are all realtors?
The Phillies.
Are you Phillies next door? Okay. So how do you become financially successful, and how do you manage your own money? Okay. So, in order to do that, in order to be financially independent, you can definitely get on that path. Because you have to take control of your own money. So, to take control of your own money, there are things that you can and you can't control. So, what can we and can't we control? So, you can't control Social Security. We know that Social Security is bankrupt, but there's nothing we can do about that. That's up to the government to figure out. Your employers, well, that doesn't really apply to you. Is most of you here 1099 self-employed?
Yeah.
Okay, so that doesn't apply to you, but you can definitely control your income, right? I mean, sell another house, right? Taxes. Well, we really can't control that either, but you can definitely control ways to reduce your taxes. Inflation and rising costs. So I just remember like about 2 months ago, gas was down to $2.18. Now it's back to $3.50. So cost keeps going up. We really can't control that, but we can definitely control how much money we have. So how do you take control of your money? Well, there's 7 things that you can do, 7 things you need to follow in order to take control of your money. First and foremost, pay yourself first. So when you get your commission check, before you even go to the bar, before you even go spend your money, before you start paying your bills, first and foremost, pay yourself first. Put money away for yourself. Treat it like a bill that you owe yourself. Okay? I know I have a lot of realtor friends. They always invite me to go to the bar. And so before you start going to the bar and spending money on alcohol, I suggest take some of that money, put it away for yourself before you even start doing it. Okay? Adjust your priorities. What is important to you? Is getting that Maserati really that important?
Sure.
Or is making sure your family is taken care of more important? Think about that. Change your thinking. And earlier we were talking about the quote that was talked about earlier. If you don't get back up, I mean, that's how you fail. So you got to change your thinking. What you're thinking, your thought. And I think this is probably the most important of the 7 different things you need to do for your to be financially successful, is to change your thinking, right? I mean, have you ever heard of the quote that if you think you can or you think you can't, it's true? Yeah, that's Henry Ford, right? So if you don't think you can be financially successful, you're never going to be able to do it, right? So you got to think you can do this. Adjust your lifestyle, all right? So do you really need to go to the restaurant every day? No, right? I mean, we need to eat, right? But we don't have to actually spend a lot of money with our lifestyle. If you're making $50,000 a year, don't live on a $200,000 lifestyle. All right? I know people who do that. They think they're rich because they think they made some money and they can go and buy that mansion, right? Or buy that car that is worth more than a house, even though they don't have that money yet. So live your lifestyle. And definitely earn additional income. You're all most of you are realtors, so sell another house. Close that deal, right? Make some more money. And avoid the credit trap. I think one of the biggest cancer in America right now is that a lot of people are in debt. And here's the thing, here's the secret. You will never be wealthy if you're ever in debt. Get debt free as soon as possible, all right? Because if you are ever in debt, you are enslaved to the banks and the credit card companies. And number 7, set a goal and have a plan. I mean, do all you guys, like, at the beginning of every month, set a goal how many houses you're going to sell, etc.? Most of you do that? You write it down, say, hey, this month I'm going to sell 4 houses or whatever. So if you do that for your profession, you got to do that for your own finances too. You got to figure out how long do I want to work before I can stop working. You figure out what your time frame is, what your lifestyle you want to have at that point in time, and figure out what you need to do, step-by-step approach to get there. All right. So you got to have like a GPS, a financial GPS, to figure out how to do that. So how do you pay yourself first? So as it says here, it's not what you earn, it's what you keep, right? So have anybody ever heard of that story about that lotto winner who won millions of dollars and in a few years is broke? Yeah. And what about like the athlete that made over $100 million and then as soon as he retires, he's broke in a few years, right? So it's not what you earn, it's how much you keep. All right, so how do you figure that out? Basically, it's very simple. Just figure out how much you have money saved, divided by how much money you made over the years, and it will tell you how much percentage-wise income saved. So the 3 different accounts you need to have for yourself. And this is important. You must have these 3 accounts. First and foremost, and probably the most important, is have an emergency fund. So it's a cash account to make sure that if you ever have an emergency, you can pay cash. So anybody ever had their car break down? Yes. Is it expensive? Yes, right? Ever had like the pipe breaks at your house, or maybe your roof leaks, or God forbid, a medical emergency, and you have a huge deductible, and you have to pay that deductible before the health insurance even kicks in, right? Expensive, right? So if you have an emergency fund, a cash account, you can pay for all that. Now most Americans today don't have an emergency account. So where do they go to pay for their bills? Anybody? Credit cards, right? So that just falls into the credit trap, where you owe a lot of money to the credit cards, right? So of all the 3 accounts you need to have set up, you need to have the emergency fund set up first. And experts say you need to have 3 to 6 months of expenses in cash, just in case. And for 1099 and self-employed, it's closer to 6 to 9 months that you have in cash. All right? Short-term accounts, short-term stuff, buying a car, buying a house, vacation. And the second most important of the 3 accounts, I would say, is the long-term account, the wealth-building account. Because whether you like it or not, we're all going to have to stop working one day, right? So the most important is definitely the emergency fund. And the second most important is your wealth building fund. So use time wisely and be consistent. So this is what I mean by that. It's always better to start early with your savings plan. So example of a guy named Paul, his parents, when he was born, invested $1,000 for him and put it away, getting a 9% rate of return. And by the time Paul reaches age 67, he'll have $400,000 on a $1,000 initial investment, right? So let's say Paul's parents didn't help him invest when he was born, and Paul waited until he's 40 to save that $1,000. By the time he reaches 67, he only has $11,000. So which would you rather have, 400 to 11,000? So it's always about how much time your money has to grow. The more time your money has to grow, the more you're going to accumulate. The less time, the less money you're going to accumulate. Same example. The longer you wait, the more it's going to cost you to save money. Basically the same concept. The longer you wait, the longer it's going to take for you to save money, or the more expensive, more money you're going to lose over time. Compound interest. So we'll skip that. So next up, the Rule 72, compound interest. Okay, so the Rule 72, before I talk about the Rule 72, raise of hand, who here actually heard of the Rule 72? So just a few of you guys, okay? So I was expecting more hands, actually, because this is a very important rule that everybody needs to understand. And this is something that the banks, the insurance companies, the credit unions, they understand this, but they don't want you to understand it. And here's why. So basically the Rule 72 tells you how quickly your money is going to double. All right? So you take 72 divided by the interest rate that you're getting on your money, and that's going to tell you how many years your money is going to take to double. So 72 divided by 3 is going to take, what, 24 years? So in 24 years, you're going to have double the money. In another 24 years, you're going to have double again. So from 10 to 20, 20 to 40. Now look at the difference between 3% and 12%. Which would you rather have? 12%, right? So you're thinking, well, four times more interest rate, you should only have 4 times more money. But is that 4 times more money? No, right? See, that's the power of compound interest. And a smart guy named Albert Einstein, I'm not sure if you heard of him before, but Albert Einstein said, compound interest is the most powerful force in the universe. So you got to make sure that the money that you have that's accumulating, that's growing, get the highest interest you can get. So, same example, more interest, more money, big difference between 3 and 9%. Same thing, same example. So, now that you know about compound interest and saving money, what about debt? So I have good news and bad news about compound interest. Compound interest, if it's working for you, is great, but what if it's working against you? If you have debt, compound interest is working against you. So you got to pay off your debt as soon as possible. And here's an example. Did you know if you put $3,000, purchase $3,000 and put it on your credit card, and you just pay the minimum balance, do you know it's going to take 10 years to pay off? And then if you just make the minimum payments, that's another $2,000 worth of interest charges. So your total cost is $5,000, right? I think most of you understand that, being realtors and dealing with mortgages and everything like that. So that's an extra $2,000 that came out of your pocket and went to the banks and the credit card company versus keeping it in your family. So it's very important to make sure to get out of debt. So another example of that, if you put $17,000 on your credit card, and the credit card is 18% interest, if you make the minimum payments, it's going to take 17 years to pay off. And your interest charge is going to be another $12,500 on top of the $17,000. So it's very expensive, and it's why you have to get out of debt as soon as possible, and why you never be wealthy or financially successful if you're ever in debt. Concepts of paying off debt, I'm going to skip that. It's a little complicated to talk about. But anybody here ever heard of a guy named Dave Ramsey? Mm-hmm. Yeah, a few people. Or Susie Ortman? Mm-hmm. Yeah. They both teach us the same concept where you figure out which debt you need to pay off first, and then figure out how to take that payment and stack it onto the next debt. But I'll skip that. It's a little bit complicated. So 5 common mistakes: not valuing your credit, raising your credit card limits, not monitoring your credit history, not monitoring your credit score, not knowing your interest rates and fees. So you got to make sure you know all about that, because that is one of the primary ways to figure out how to avoid the credit trap. So now that you know you're supposed to get out of debt, now you know you're supposed to save money for yourself. What if something happens to you today? Before you get home, something happens to you, you pass away. I want you to ask a question to yourself right now. If something happens to you today, can your significant other, your spouse, and your kids, can they still pay the bills? Can they still keep living at their house? Can they still put food on the table? If the answer is no to any of those questions, you need to get life insurance to protect your own family. You see, when you have a car, we all buy auto insurance, right? You want to make sure that if you hit someone and you have auto insurance to pay, so that they don't come back and sue you for everything you have, right? So how much is your car really worth, right? If you have a house, you want to make sure you have home insurance. Just in case your house burns down, you want to have the money to build it back up, right? So that's why, but how much is your life is worth, right? Definitely more than your house and your car combined. So it's probably more than your car and your house combined, so it's important to make sure to protect you and your family today. So, but you don't need life insurance forever, all right? You only need it for a short period of time, right?
Until you die.
What's that?
Until you die.
No, not really, not actually. See, you only need life insurance when you have responsibilities. Okay, so here's an example, and this is how how family works. So, or how life works, okay? So when you're young, you don't really have a lot of money saved, do you? So you need life insurance because something happens to you, you have young kids, you have high debt, you have a house payment, so a loss of income will be devastating for your family. So that's why you need to have life insurance. But as you grow older, you have time for your money to grow, to accumulate, and you're eventually going to have a nest egg. And as you get older, your kids grow up. Hopefully they move out of their house, right? So hopefully they don't depend on you anymore when they're in their 40s, all right? So your debt gets paid off, your mortgage gets paid off, and you better have money saved up because if not, you're going to still be working. And you don't want to work when you're in your 80s, all right? So you want to make sure that when you're older, you better have money. So since your kids are grown, your debt's all paid off, if anything happens to you, you have money set aside for yourself, for your family, that they can use to pay their bills. Am I correct? At that point, you do not need life insurance anymore. Because life insurance is only for when you have responsibilities. So I'm going to tell you a secret here about the life insurance industry. There's two types of life insurance out there. One is called cash value life insurance, and one is called term life insurance. So the life insurance industry likes to sell you something called cash value life insurance. It's basically an investment with savings attached to it. They sell it as a retirement plan. They sell it as a great way to avoid taxes on your money. They sell it as some type of college plan. But all experts tell you, never buy that stuff. Okay? This is from the Wall Street Journal. In short, term life remains the best choice for most people. Smart money, the right type of life insurance can be summed up in a single word, term. New York Daily, going with the more cost-effective term policy will likely serve most people better over time. And Wall Street Journal again, for most people, term life still offers the best combination of coverage and cost. Okay? So, the three nevers of buying life insurance. Never buy life insurance that called cash value, also known as whole life, universal life, flexible premium adjustable life, equity index life, any variable life, any of those things that help you save money, never buy it. And if you have one, you've been ripped off. Never buy life insurance as an investment. If someone tries to sell you a life insurance and say, oh, it can save money for you, run the other way. They only care about themselves. They don't care about you. Never buy a life insurance policy that pays dividends. You think, oh, dividends, pays dividends. You think dividends is good. Let me tell you, in life insurance, well, you know what dividends is? It's a return of premiums because you paid too much. It's like if you bought auto insurance, it's supposed to only cost you $500 a month or $500 every 6 months, and they charge you $1,000 for it. And at the end of the 6 months, oh, well, we collected too much money, so we're going to give you back maybe $200. That's dividends. That's how dividends work with life insurance. You paid too much, so they give back some of your money. But I'll go for this. There are two types of retirement plans out there. One is called traditional IRA, one is called Roth IRA. So I'm going to quickly go over the difference between the two. Okay, traditional IRAs is basically tax deductible, so you can use it to deduct your taxes every year. The earning girl is tax deferred. And when you start taking money out of your plan, that's when the government taxes you, okay? So the other type of retirement plan is called a Roth IRA. And that right there is, you don't actually get a tax deduction right now when you put money in. But it's also gross tax deferred, but when you take the money out later on at retirement, it is completely tax free. You heard that right, tax free. So you don't have to pay any taxes on any money that's earned inside your Roth IRA, okay? And anybody can set up one of these accounts. There are some income criteria regarding the Roth IRA, but we can go over that. You can ask me more about that later. So you can actually be financially successful, okay? The path to financial independence starts with understanding a few basic concepts and implementing them, all right? Winning the financial war is a tiny battle day after day, and you got to put a simple plan together, a simple financial plan and you'll be amazed at your progress as long as you follow your simple plan. All right? So thank you for your time, and if you have any questions, feel free to ask.